Oh yeah, that was a Becky project. Yeah. She was very excited for that. Yeah.
All right, we're going to start. We will call to order the May 8th meeting of the Oklahoma City Post-Employment Benefits Trust. And we are going to move around on the agenda here in hopes that our investment consultant is here and can present a couple of items for us. So I'm going to jump all the way down to Jake on the interim financial statement on item. I guess I could go ahead and do the minutes. Yeah. So let's go ahead and approve the minutes.
Move approval. Second.
All in favor?
Aye.
Any opposed? All right, now we'll move from item 2 down to item 7, and we'll do an acceptance of the interim financial statements for the 9 months ended March 31st, 2017. And we have Jake Siebnaler here from the Accounting Services Division.
Good morning. We just want to highlight a couple items from this most recent financial. So if you'll start, we want to flip over to page 3 of the MD&A statement. Currently, we're looking at a trust net position of $46.37 million. This is an increase of $5.2 million over the prior fiscal year. The prior fiscal year was $41.16 million. So in comparison to the same time period for the prior year, contributions have decreased $2.46 million. Net investments income has increased $5.5 million, and deductions paid has increased $1.19 million. In the current year, the net position has gained $5.22 million, which is an increase over the $3.68 million gained from the prior fiscal year. So we're still actively gaining on our investments. The next thing we want to flip over to is page 10 under your deposits and investments section of the notes. On this section, we'd like to draw your attention down to the money markets, where we're looking at, for the current year, a reported amount of $2.86 million, and this is compared to $5.29 million. And money markets are usually used to pay our active claims going through, since we can easily access that money. Finally, we want to flip to page 12, so we look at our asset allocation guidelines. We're showing fixed income securities are reporting at 33.9%, leaving the remaining to equities at 66.1%. Are there any questions at this time that I can answer for you?
Sorry. Hearing none, I will accept a motion to receive or accept the interim financial report for the 9 months ended March 31st, 2017. All in favor? Aye. Any opposed? Thank you, Jake.
Thank you.
And now we will pause. We will pause for a very slow. Actually, we can go ahead and ratify claims, I guess. So how about on item 8, we ratify the claims listing? All in favor? Aye. Any opposed? All right. It's a bad thing when your meetings move so fast. And I hate to ask if we have any other items without Bob in here. Do you know if there's anything else that he was going to cover? Okay.
Maybe we could, I know Diana had a quick update the other day on the use of the clinic, retiree use of the clinic. Do we have an update on that?
Okay.
Sorry, pop quiz.
Dixon's about a block away.
Block away. All right, we're going to give him a block to get here.
I don't have information on the Medicare retirees. We're tracking the Medicare retirees separately, so I don't have that information yet. But I can tell you that overall utilization among our retirees and active employees is about 25-26% after a year and a half of the clinic being open, which I think is very good. Overall, with all of the dependents, it's about 13%. So we are going to have additional meetings with employees and retirees to provide information about the benefits of using the clinic with the hopes of increasing utilization even more.
Thanks.
And you said it was 25% usage overall for all employees and actives, and then if it's including the dependents, it's 13?
Yes, including all of the dependents, it's about 13%. And I do need to remind you that on March the 1st, we extended the clinic eligibility to the Medicare retirees. So everybody who is covered by the city's health insurance plan and their dependents who are also covered as long as they're age 2 and above are now eligible to use the clinic. And I will tell you that Carrie TC, the clinic operator, has said that there has been good utilization by the Medicare retirees, so that's great.
Great. I know I hear a lot of positive comments from people that, you know, everyone I've heard going to it has been very pleased with the service, pleased with just how accessible everything is. Even people, I mean, I talked to a police officer that was coming out and the other day just on the sidewalk, and he was saying he was trying to tell everyone about it because it's just so easy. And he still had to drive down, but it's just so, it makes it so accessible, so easy. So really good.
Well, I think it's good to mention, and thank you, Laura, for bringing this up, but I do think it's good to mention that anybody who is eligible to use the clinic, those services are provided at no cost. So any medical treatment you receive over there, any laboratory services that are necessary, any prescription drugs that the doctor prescribes that are carried in the clinic, those are generic prescription drugs. Those are no cost to anybody who uses the clinic. So we definitely encourage individuals to utilize that, since it's a significantly less cost option than the health insurance plan.
I do think that's a really important point, because maybe that's something we need to mention to our actuary when we get our next evaluation of the Opebt Trust, is whether or not that change in eligibility has had an effect on, or will have an effect on, our projections.
We did have some discussions with them, and they have said right now I mean, I think the change in eligibility has a really a small effect, and the bigger change in, you know, making the change in, you know, after January 1st, anyone hired on after that date will have a larger effect, but over longer time. And so it's like in the interim amount of time, there isn't an expectation that it'll be a significant change as a result of that. And one other thing I wanted to mention along those lines too is Jake pointed out that our contributions are down for this year, and one of the things, and we've had discussion before, but I know when time goes on, it's kind of hard to remember all the discussions that we've had in regard to this. But in the past, the city had been paying in over and above the pay-as-you-go cost between $4 and $5 million a year. That dropped this past year due to our budget constraints. We decreased that additional amount. Going into next year, we're going to be moving towards a pay-as-you-go, just covering at least the pay-as-you-go cost, just again because we're in the process of cutting positions and eliminating police officer and firefighter positions. And so in the midst of that, we really weren't in a good position to continue contributing over and above the pay-as-you-go cost. And so just something I wanted to make sure everyone was aware of. We're evaluating in this year, there's some that's budgeted that's a little bit above, but we're evaluating how much fund balance in the general fund we may have to use this year, so we may even trim this year's contributions back. And so I just wanted to make sure everyone is aware of that. If we do make that decision, I will make sure and be in contact with everyone if we get ready to do that.
And the only other thing I want to mention along these lines is that at some point when we are able to ascertain utilization by the retirees, this body, this trust, will need to consider what contributions, if are necessary to continue that utilization. Thank you.
Thank you. And we're going to go to item number 3. We've got item 3 and 4. It's the item 3 is a presentation of the investment performance review, the quarterly report for the period ended March 31st, 2017. And then item 4 will be receiving the monthly report for April 30th, 2017.
Good morning, everyone. The larger book is the one that we'll be referring to first. Not a lot, I won't spend a lot of time on market environment, except to say that performance was generally quite good during the first quarter of 2017. On page 2 of that report, you'll see a column of text on the left and bar charts on the right-hand side, and we list performance of various parts of the market or investable universe on the right-hand side The top box is the quarter-to-date returns. The lower box is the trailing 1 year. So this is the 1 year ended March 31st. So looking for the first quarter, you can see the maroon set of bars are non-U.S. equities, and they did very well. You can see that ACWI ex-U.S., that means all countries except for the United States, were up 7.9% during the quarter. EFA is developed markets only, was up 7.2, and emerging markets was up 11.4. So performance internationally was quite good. Suffered during the fourth quarter of last year, post-election, as the U.S. dollar strengthened during that period of time, but the strength of the dollar abated somewhat during the first quarter, helping performance. The middle set of columns are for U.S. equities, and you can see for the quarter, performance sort of favored the top set of those, which are larger companies. The S&P 500 was up 6.1%, the Russell 1000 virtually the same. And then going down to small cap companies by the Russell 2000, those are the 2,000 small companies in the U.S. Stock exchange, up 2.5%. And that, again, was a real switch from the fourth quarter of last year, where immediately post-election, smaller, riskier companies did better post-election. But then you can see that the baton of performance was passed to larger, more growth-oriented companies during the first quarter. And a lot of that is due to tax, potential tax code changes, potential changes in regulatory structure. And we're actually seeing, I read a story over the weekend, Warren Buffett was saying that many, many companies out there are changing their capital investment plans going forward, planning if there may be a reduction in the corporate tax rate from 35% down to 15%. I know 35% does not sound maybe significant at the corporate tax level, but that is the highest in the developed world. And if we can get a reduction from 35% to 15%, not only does that mean additional funds flowing to the bottom lines of these companies, but it also means that capital expenditures will be accelerated greatly through the end of this year because they'll be deductible at the higher 35% rate rather than 15%. So if we get some indication of that tax rate, corporate tax rate going down, potential of that happening, see some significant economic activity for the remainder of this year or until that tax rate takes effect. Looking below that, you can see the bond indexes were down 1%, slightly above or below there, and T-bills still at 0.1%. A lot of mixed news on the economic front. When you take a look at the hard economic data, it's fairly soft. First quarter real GDP was up less than 1%. But if you take a poll of corporate spending, officers, et cetera, they're very enthusiastic and they project high economic growth going forward. So the gap between what we're observing in the recent past and what we're seeing from humans' expectations looking forward is fairly enthusiastic, and that gap is relatively large. I'm not sure if that means that we're up for disappointment or hopefully positive growth going forward. The following pages are very in-depth view of the market environment. I won't go into that too much except for saying that risk-taking since the election has been rewarded fairly well, whereas before the market's kind of held in. I will say that equity prices are on the high side right now. Bond prices are also a little bit on the high side, and volatility of the marketplace is relatively low. If you're looking for attractively priced investments, those are fairly few and far between, and it takes some real looking to do that. Non-U.S. is cheaper than U.S. When it comes to equities, but not for fixed income. So we need to be very diversified and deliberate on what we're doing here. Page 10, the most important page, the total fund 1 year trailing return 12.6, and I don't think that we can change the fiscal year. I saw the question.
I keep exploring that.
I'm not kidding. In 3 meetings I was in last week, or 2 meetings in a row, I had 2 completely separate and independent clients in different parts of the world say, can we just go back to 2009 and allocate up to equities from that point? And so it's environments like this that are better than we expect, I think, that maybe cause the mind to turn to the Wayback Machine, or as we call it, hindsight capital management.
Right.
But looking forward, I think that the portfolio is very well diversified, and that's what we need to keep thinking about here. So page 12 shows a very nice, strong growth picture here. And you'll see that the allocation on page 13 and 14 is shown in some detail. And thinking back to 2009, which is very early days of this plan and very risk-averse time. Remember, we didn't want to lose significant amount of principal in the most unusual and treacherous market environment since the Great Depression. And in my experience, we had very low exposure to equities, both domestically and international, until about 2011, when we did increase that stepwise function. You'll see where the allocation is now on page 14, 60% in domestic equities, which is a little bit on the high side, but I think that also recognizes that this is a long-term investment vehicle. Next after that is core fixed income at 18%, international equity at 10.2%. So when we're looking at this, we have a 70% allocation to equities overall. That is diversified, but that's where the equity allocation stands. Active duration fixed income at 8.4, high yield fixed income at 2.9, and do remember that we recently did talk about asset allocation and perhaps moderating that, and I think that's an agenda item further down today. Looking at page 16 is something that I like to look at, the composite, the total fund composite, and the individual portfolios, and where we started the quarter on the top line there is $42.148 million. You can see contributions of $17,000, income of $182,000, and appreciation of $1.7 million. So it's a very, very good quarter, giving an ending market value of $44 million. And where did most of that appreciation come from? Domestic equities, and the largest proportion there was the index fund, the S&P 500. Pages 17 and 18 show the total fund rate of return as well versus policy index versus actuarial assumption, et cetera, and then all of the sub-portfolios going down. So the 1 year total fund, 12.6%. The index was up 11.5%, so we outperformed. The portfolio did very well over the last year, and that ranked in the 9th percentile of its peer universe. So we're seeing some significant improvement in that area of relative performance. I'm not overly concerned with how we're performing versus peers, but versus the goals that we have for ourselves, and primary amongst that is the actuarial assumption. That's what we have to beat reliably, but we also want to build capital and grow the principle of this over time, but not taking too much risk. As we go down the 1 year column, you can see the returns here. Loomis sales, the fixed income portfolio, it is relatively aggressive on the credit perspective, but it was up 9.42%. Index was up 0.44. I want you to look at that and understand that it's a first percentile rank and possibly the highest outperformance margin I've ever seen on a fixed income portfolio. How did they do that? Well, you had to live through 2015 with Loomis sales, and if you go to the next page, you can see that they were down 6% during that, almost 7% during that year, while their index was up marginally. They weren't foolish in 2015, nor were they the smartest people in the world in 2016. They're committed to a deep value investment strategy, and sometimes you see these peaks and valleys in it, but we're very happy where we stand today. Double line is a more diversified, sort of a macro look at the world, and they do allocate amongst sectors. They were up 3.11%, still outperforming the index by, what is that, almost 8 times, 8x outperformance. That ranked in the 8th percentile, so we're happy with that. Our high yield portfolio is up 17.59. Again, that was above benchmark and top percentile, or top quartile, or decile, I'm sorry. And then we have our hedging portfolio with Hoisington. Macro focus, they invest only in treasury bonds, and they were down 6.94% for the year. And again, this is a portfolio that we hold for many reasons. It provides income, it buffers equity market volatility, which we have had very little over the past year, and it also can buffer some macroeconomic uncertainty too. When equity investors or the world of investors grow very fearful, they invest in treasuries. And this portfolio, I know If interest rates were to rise again, they have the ability to switch to a short duration to participate in the positive side of rising interest rates, whereas the other portfolios don't have that flexibility. The index fund was up 17% last year. The S&P, the Vanguard mid-cap was up 16.6%. Hotchkiss & Wiley, again, a deep value manager. Some years they look great, other years not so great, but over the long term, I think over the last 15 years, they're first percentile manager. They were up 20.6% for the year. We're seeing some improvement from Stevens, but again, that's an area of the market that is characterized by high risk taking, some very risky companies in there, and we chose Stevens because we wanted to have some exposure to growth. We wanted exposure to small cap, but we wanted to be deliberate and cautious about it, and that's the role that they fulfill. In our international equity portfolio with Causeway International, value is again very cautious portfolio, 13.49. I would expect this portfolio to be doing very well today, given the weekend's elections. And initially I saw that European stocks were poised to do very well today. So performance, 12.6%. Fantastic result, much better than I would have thought a year ago coming into this meeting if I were to project what was going forward. Our managers are doing well. The active-passive structure on U.S. equity, I think, is still very prudent. Our fixed income portfolio I couldn't be more pleased with when we see all of those results together. And knowing that Hoisington is going to offset virtually every other asset in the portfolio, and that's what we expect them to do. I'm going to skip over the individual fund pages, but they are there, and they show you characteristics about the portfolios. I will say that there are no unexpected issues with any of the portfolios. There are no notable changes with any of the organizations that we need to pay attention to. And as we go to pages 40 and 41 and 42, all the funds are in compliance. I recommend no changes there. Page 41 shows the expense ratios for these funds we're investing in. And again, something we're watching very carefully as the fund grows is, are funds the cheapest alternative for us to invest in? At some point, there's a break even where a separate account would be cheaper, but we're not there yet. Something that we are watching carefully. Expense ratio on a weighted average basis is 43 basis points, which is inexpensive. The category weighted average expense ratio is 70 basis points. So from this comparison here, you can see that we're saving, versus the average fund out there, $100,000 a year on fees. And the following page shows the, 42 shows the asset allocation with the current targets, and I believe we'll be talking about this in a few moments. Mm-hmm. And I do like on pages 43 and 44, just for extended views of performance, we show all of the funds with much longer than we have held them within this portfolio versus their benchmarks, going out all the way to 15 years. And on page 44, we show the individual calendar year returns versus benchmark to give some exposition on how performance can cycle through these. While I said a moment ago, I thought that Loomis Sales was the largest gap of outperformance for a bond manager I've ever seen. Same for a core fixed income manager, that is definitely true. But if we're looking on page 44, and if you look across at Hoisington, there are years where they're not so great. 2015, they weren't so great, but 2014, they were up 32.58%, and the index was up 5.97. So Hoisington really lives in a realm of their own. They're not like any other manager out there. They're very specialized in what they do, and they can outperform by truly massive margins. I would not want the entire portfolio to be invested there, but I do very much advocate them having a role in return production and also risk reduction versus the equity side of the house. Happy to take any questions.
How did our, I was trying to think back, our expense ratio.
Yes.
You know, since we had taken some of our portfolio and moved it into an index fund, did that, I mean, obviously it has an effect to improve our expense ratio.
Right.
But is this better than what we've had in the past?
Yes.
Is it improved? Okay.
Yeah, when you look at, say, and I know that we split the mid-cap into, so you're looking at 20 basis points on the mid-cap index versus 102.
Which page are you on?
I'm 41. Thank you for asking that. So if you look at Hotchkiss and Wiley and Vanguard, that used to all be actively managed. And so when you go from 102 to an average of 102 and 20, that reduces that portion significantly.
Yeah. Okay.
And another thing is when you go to the Vanguard 500 index, remember that we had Dreyfus appreciation, which was, I believe, 54 basis points, and that's a large part of your portfolio. So this looks, from a fee perspective, significantly lower than it was a couple of years ago.
Okay. Are there any other questions on the quarterly report? All right. And then we are ready to receive the presentation on the April 30th investment report.
Thank you. Literally hot off the presses when it was sent over here. Market environment, you can see a little bit of a plateau during the recent month, but performance has been extraordinarily good so far this year. Russell 1000 year-to-date is up 7.15. The 2000 is up 3.59. So again, we're seeing performance favor larger companies over the recent months, and then most of that happened in February. Non-U.S. equities up 10.17%. So we're seeing a resurgence in international equities, and fixed income up 1.59%. And it's looking like interest rates at the short end of the curve will be going higher as the Federal Reserve continues to tighten in what we think is a slowing economy. Total fund composite on page 1 there, you can see for the month 107, for the quarter 375, for the year 1234, so not much change over that last month. And if you look at the performance for the month, Loomis sales up 191, Double Line 167, Lord Abbott 296. All three of our fixed income and our two core fixed income and our high yield manager outperforming. Even Hoisington outperformed during the month, 257. The S&P index 513, right at its benchmark. The Vanguard 500 at its benchmark. Hotchkiss is running into a little bit of trouble right now. I'm supposed to have a conference call with the portfolio manager later today, but again, not unusual to see that happen. And Stevens, again, very cautious growth manager on the small cap side. And then our international equity portfolio coming in for the quarter, 7.2, better than the index, and 1325 versus the index. So some improvement there as well. I know performance looks good right now, but we do need to remember that it won't always be this good. On a relative basis, it won't always be this good. On an absolute basis, it won't always be this good. I'm not predicting imminent doom by any means. I hope not. But their markets do move in cycles, and we've been at the positive end of the cycle for quite some time now.
All right, are there any questions for Doug?
No, but am I the only one whose page
Mine
is?
did too.
Okay.
I don't know if on the electronic version, it's on that first page, it's not page number 1, but the first page.
The market environment?
It looked like it didn't size correctly for the sheet.
All messed up.
And I don't know if the electronic version was that way, or it was just how it
I
printed.
think we have enough information.
It's just how it
to-
prints. It's with the electronic file that we get. We'll just have to make a point in the future to kind of check that when we start the printing process.
Okay.
Just to make sure it prints out properly.
I'm sure there's enough information here for us to receive the report. It's just, it'd be good if we could get
Good
the
to have
whole
everything,
page.
right?
Okay,
Oh, those computers.
yeah.
Yeah, that's right.
So can I get a motion to receive the April 30th, 2017 preliminary performance report? All in favor? We don't actually receive, we just take a presentation on that one, because we receive the individual reports. So all in favor was aye. Any opposed? Great. Next was discussion and consideration of any asset allocation changes, and we don't have any asset allocation changes today, correct? We're going to make a change in the policy, but
Correct.
it doesn't make any change in any investments currently.
Correct.
Okay. So on item 6 then, Doug's going to give us an overview on our changes to our policy, to our investment policy. So Doug, if you'll lead us through that.
All right, I'm locating the document right now. So it is a good idea to, on a regular basis, to take a look at the investment policy statement and to update it. And you'll have two versions in your packet today. The one is the redlined copy. And there were a few small changes to this. And as I'm paging through, updated some index names. On page 7 of the redline version, you can also see updated a few items on the judgments, and I've been in contact with Bob about some of the particulars of that. And then as we go to page 8, you can see that there is a change in the asset allocation there. After our last investment committee meeting, decided that 70% equities is a little bit strong, and dialed that back from a 60% allocation to domestic equities to 55. We increased core fixed income. We increased our active duration fixed income and our high yield fixed income moderately.
So and one of the things we talked about earlier was it just changes the targets. It doesn't change our minimum and maximum. So if you need flexibility within the minimum and maximum, we didn't make any change there. It's just on those targets.
Yeah, that's absolutely correct. And if you look at these, the way that those minimums and maximums are set up, it's to minimize risk, right? It's the target is not in the midpoint of core fixed income. We can go from 21% as our target all the way up to 65% fixed income. So that's a low-risk asset class. If the markets are extraordinarily risky, we can go up to that low-risk allocation again. You can take equities all the way from 55% domestic equities, 55% target, down to 30%. But the maximum is just a 10% bump from the target.
So, Doug, my question is, because we changed our target in the investment policy, and I believe our domestic equity is currently at 60%, are we going to reallocate some investments to get down to the target?
Right, that's a matter of time, and so this is something that Bob and I talk about frequently. What we want to do is minimize the amount of times that we touch the portfolio. So if there's a cash flow coming in or cash flow going out, we'll use those primarily to affect these changes. But we also know that we need to get to target quickly, and it's I think it's a great time to take profits. So we'll be talking about this. The investment policy allows some flexibility as far as timing on this to Bob.
Yes, we do have it in our investment policy where we have some flexibility. It doesn't have to be immediate, that we can reallocate, like Doug said, over a period of time. So you have that flexibility available to you as a board.
Thank you.
There was one piece, and all of this was included in our discussions at the last investment committee meeting. One of the last pieces that we talked about was when we were talking about judgments, that we do receive judgments for the city. Some of the judgments that are rendered not in a Oklahoma District Court, but some are rendered in a federal court, and the differences in the interest rate on those. And I expressed some concerns that, the federal court can vary. It can be very much lower rate. And so what we had talked about, or the directions that you had given me at the end of the last meeting was, go ahead and work with Doug and add some language into the investment policy to accommodate that. So what we did was with Section 3B8, we had in there State of Oklahoma judgments to start out that paragraph.
Page 7.
On 7?
Yes, 7 of the red line.
Got it. I'm sorry, go ahead.
Yeah, page 7, sorry. At the start of that paragraph where it says the State of Oklahoma judgments, that is actually supposed to be stricken, and instead it should say judgments rendered by district courts in Oklahoma. And what that does is just basically restrict the judgments that we purchase to only be those that are rendered in Oklahoma district courts. What that does is, just as an example, current federal court rates run around the Treasury bill rate, which is around 1%. Those rendered in district courts in Oklahoma are based on an annual rate that's set here in Oklahoma, and it currently runs about 5.75%. So it just makes sure we get a good return on the ones that we purchase. Okay.
Bob, while you're still there, I've got a question on that section on the barring any conflict of interest. Just for my curiosity, what would trigger a review of a potential conflict of interest, and by whom would that decision be made?
Well, that really came about from some of the things that Doug had seen with some of his other clients, in that some of the judgments that were being rendered against some of his other clients had the potential to give that appearance of, hey, you're funding this judgment for, this certain lawsuit that had an impact on the client themselves. And so just to kind of review those, include that in a review process, not necessarily say that's a bad investment for the Opebt, but it gives us the opportunity to review those and say, if this looks like there is some sort of conflict of interest to the Opebt, maybe we can back out of purchasing that particular one. But it just gives us that option to have that additional review process as these judgments come before us to be purchased.
And I think the goal, too, is ultimately to be clear that our intent of using that would be as a tool for investment, not for benefiting the city. Our role is to benefit the plan, and so just make sure it's really clear that we don't allow for any kind of political pressure that would put the board in a position that we feel like we're making a decision that's a less than advised decision on an investment, right, just for the purpose of making the purchase of the judgment. So it's just
and I certainly agree with the principle. I was just curious as to what the mechanism for review would be. Do I hear you saying that any time we consider a judgment that we would automatically review for a potential conflict? We review every one of them,
the ones that come before the Opebt, right?
Thank you.
And our plan then would be just to implement that as you all see opportunity working together, that there's an opportunity for purchase of judgments and we believe it's a right time, or we're in a right position to be able to make that investment.
Correct. We have that opportunity now, but currently pretty much all of the judgments are being purchased by the retirement system that are fit for an investment. So we'll work within those constraints and with legal to determine whether or not, and at which point we'll go ahead and start moving some of those towards the Opebt.
Okay. Great. Thank you. Now, do we need to make an amendment, or just when we make the motion, will we need to vote the amendment?
You could include it in the main motion.
Okay.
The amendment on
Okay.
7.
Great.
I noticed, though, that it looks like it's correct in the non-strike-through version.
Yes, and that was one thing that we talked about at the investment committee meeting. Normally we have an action that says the investment committee recommends to the board these actions. This time there wasn't an action available to you on the investment committee agenda. So the thought was these will be recommendations from the investment consultant, and this one would be from me, and y'all would just approve our recommendations.
Okay, so our plan is then we vote today on the changes in the policy.
You're approving our recommendations.
Okay, so we'll approve your recommendations to amend the policy.
Right.
And then what Laura was saying is that is actually listed correctly in the clean version. What you're talking about, where State of Oklahoma judgment should have been removed, but it's actually correct in the clean, so then we wouldn't have to amend.
Yeah.
Okay.
Okay.
Okay. Just want to make sure we're all on the same page. Was there anything else, Doug?
Those are the most important points in the policy.
Okay. I want to express my appreciation to you and Bob for the work on cleaning this up and doing the review, and the work that what you provided to us at the investment committee, just giving us more education about the process and helping us think through the policy. So good work, and I appreciate your leadership on that.
Thank you very much. I enjoy the work a great deal, especially when I get to work with Bob.
Yep, thank you. So we are on item 6, to approve the recommendation from the investment manager and on the trust investment policy. Take a motion.
Move. Second.
All in favor?
Aye.
Any opposed? All right. And are there any other items? I think we've covered everything else. Are there any other items or reports from trustees or staff? And hearing none, we are adjourned.